get this question all the time. When is the best time to jump into the stock market? And it's actually now. Why? Because during crashes, there's always going to be cheap prices and also companies that are going to excel during crashes. In 2008, there were companies that were excelling during that time. During the pandemic, there were tons of companies excelling during that time. Look at Zoom, look at Moderna, look at Novavax. And especially during this crash, which are the ramifications of the pandemic, there's going to be more companies that are going to excel. So in this video, what I want to jump into is finding these companies, knowing how to trade them on the short-term charts and being able to pull profits from those. Because I know a lot of people, they don't want to look at more long-term investing. They want quick cash, and I understand that. So essentially, I want to show you pretty much the best ways to do that and not lose money at the same time, especially if you're new to the markets. So what are the setups I'm looking for? So simply put, I'm looking for gap up and go or gap down and crash. This is going to be the dichotomy between me going either long on a company or going short on a stock. So I'm going long if it gaps up and goes, it chooses a direction to the upside, or if it gap down and it crashes, then I'm looking to bet against it and make money into the short sale pretty much. Now, the environment that you're going to be seeing these companies in, they're going to be in extremes. So in extremes on the scanner on, let's say, the highest percent gainers and also the lowest percent gainers. If it's gapping down, it's going to be a negative percentage. If it's gapping up, it's going to be a positive percentage. I try to see things that are above 15% in either way. So 15% positive or 15% negative. Anything that's within the mundaneness of 5, 7, 10, 15, let's say 12%. That just doesn't attract enough attention. We're all looking for the biggest movers and the biggest losers. So in the extremes, you're going to find that volatility that I'm looking for. Now, with that volatility in place, there is going to be a lot of upside and downside movement. So I specifically pit a 5-minute barrier before me pressing any buttons as that company opens. Because during that open, there's going to be a lot of what I would say different opinions that turn into actions. So some people that are holding a company throughout the pre-market, they're going to say, hey, this is overpriced, I'm going to sell at the open. Then there's others that are looking at it and saying, hey, it's gapping up and it's looking to go, I'm going to buy it at the open and looking forward to continue in this direction. Either of these people can be wrong, but there's so much tension built into the open, there's going to be a variance in prices that go all over the place. You're not going to see clarity, not until you start to get past that open. So that's why I try to make sure that I'm not taking any actions. I break this rule sometimes in my own detriment, but I try to move that actions past the open. The further I'm past the open, the more clarity I have. After that, the next thing I'm going to be looking for is some form of directional bias. This is probably one of the most important things, is staying on the right side of the trade, not fighting the trend, not fighting where the majority of people want to push this company. I understand that we always want to think that we're on some next level of thinking and we know what's going to happen before it happens, but you don't want to get destroyed on the way to being correct. Remember, you can be correct in the long term, but in the short term, you can get destroyed. So essentially with my directional bias, what I'm looking to do is stay on the right side of the trade, which means I need certain actions to happen. So if I'm looking to go long on a trade, I want to make sure that the company is actively green on the day. That helps the sentiment overall to be more bullish. And inversely, if I'm looking to short, I like companies that are red on the day because they have a hard time breaking back into that green on the day status. And I kind of know where the lines in the sand are. Like the opening price is very, very important. The VWAP is important. Being above the VWAP typically leads to much more bullish plays that can run for longer periods of time. Being below the VWAP has that inverse effect. These companies are going to start to draw down more and more consistently. So you want to align the direction that you're looking to go after. If it's gapping up and going, you want to make sure that you're aligning yourself in those directions. And that helps you in the long term. You're not going to see it in a individual trade basis, but you're going to see it if you start to track your trades, use like TraderView or use some form of trading journal. If you can look at these companies in a sense, you can sort these by the green or red on the day status, them being above or below VWAP, and seeing your accuracy, it will improve over time. So that's kind of very important. The next thing I'm looking for is the confirmation to pull the trigger. This is very, very important because the 90% of traders out there don't pull triggers on confirmation. They pull it based on emotion. Hey, it's running. I don't want to miss out. The fear of missing out kicks in. They press buy buttons. Oh shit, it's pulling back. Blah, blah, blah. And then boom, they sell and sell for a loss just for that opportunity to be a dip buy opportunity and for it to bounce back up. So essentially what you want to do is you want to base your trigger pulling based on some form of concrete trigger or concrete confirmation, if that makes any sense. So like, for example, I use cheap entry opportunities. I'm never looking to buy the run up and sell into the run up. I'm trying to buy the dip and sell into the run up. The majority of people are literally selling dips and buying into run ups. And it's easy to say, oh, well, it's easy to look at a past chart and see that. But if you have to condition your trading to only be buying at certain times that are going to align with cheaper entries. This is why I like to use the 9 EMA as a target entry point. Even though it's never going to be the absolute cheapest point you could ever get, it aligns itself with, I'm never going to buy the top, or I'm never going to buy, like, I'm never going to chase, or I'm never going to buy the high of the day if I'm always choosing the 9 EMA. 9 EMA is a lagging indicator. Even though people talk shit about lagging indicators, they have a built-in kind of fix where you're never going to be buying tops. So in situations where a stock will rapidly run up, that lagging indicator is going to stay behind, and it kind of gives me a desired point of entry. If it never reaches that point, I'm never going to touch the trade. And I know if I do enter a trade above that level, I have more risk associated. So I can almost use that as a risk assessment tool to say, hey, the further I'm away from the EMA, the riskier this trade is. Doesn't mean that the trade isn't going to go in my favor or is it going to go against me. It just knows that I'm risking more to jump into that entry, and it better be damn well worth my while. So that's pretty much what I'm looking to do. Now, the thing is with confirmations, as you progressively get higher in the company, let's say you're going long and a trade is successful. Remember, every consecutive setup that does develop is essentially going to get weaker and weaker and weaker the majority of the time. Sometimes they do ramp up as more volume comes into play and moves up higher on the scanner, and people just start to talk about it on Twitter and all the social medias. But consistently, as it goes higher, it becomes weaker in its overall move, and it becomes more volatile. So these confirmations need to still be seen in the viewpoint of, where's the company since it started on the day? If it started on the day at $2 per share, now it's at $6, and you're looking for confirmations, I think you kind of missed the main run up there. Hopefully you grab profit on the way. If you haven't, let it go and then look for something else. And finally, have an exit plan. So if your exits are purely based on emotion, hey, it's running and it's running, or let's say with the majority of the time, hey, it just dipped very, very drastically, let me look to sell my position. If you're selling purely based on emotions, just like if you're pulling triggers based on emotion, you have an emotional trade, which essentially you're just going to be a slave to whatever's happening on the chart. So what I'm trying to do here is, you need to stop using like these arbitrary targets. It happens all the time. If you buy at a certain place, there has to be a logical process that gets you to that end point of that exit. Where that exit point is has to be based on something. Either it's based on, let's say, a 2-to-1 risk reward ratio. I'm risking 3% to the downside, so I'm looking for a 6% profit. Hey, I'm looking at a 20 cent per share risk, so I'm aiming for 40 cents per share in profit. There needs to be a logical process. If your process is purely, I'm just looking forward to sell it at X price, then there is no way you can replicate that down the road, because there's no process to getting there. You can't always chase your tracks. So there needs to be some form of technical or some form of risk assessment that gets you to that exit point. Another thing too that I see on a lot of rookies is selling their full position into run-ups. Now, I understand a green day is a green day. You'll never hear me complain about having a green day, but there is still ways you can be more efficient, which means that if you sell into a run up, don't sell your full position, sell half of it, let the other half ride, and so you can stretch that a little bit further. Since you're only holding a half position, it's weighted less. So any upside or downside move isn't going to be as weighted as a full position. So you can hold through more bullshit in between you getting to your end goal, if that makes any sense. So selling progressively to the upside is very helpful. Also, selling progressively when things do go against you allows you that second win to possibly negate a loss or try to minimize it as much as possible. For example, if you buy into a company and let's say it quickly starts to dip, if you sell your full position, you just accept a loss on a position. Now, if it does dip, you sell half, and let's say it starts to rebound as people find a cheaper opportunity, start to dip in there and they start to buy up that company, starts to pop back up, essentially, if you sell half your shares for a 5% loss and the other half for a 0% loss, you sell back at your entry, you only lost 2.5%, which is much better than losing 5%. So you can see that you can start to negate losses by progressively selling. So all this really means is that you don't really want to base everything purely on a block trade where you just buy one large position, sell one large position, progressively do it. Now I always get the question, well, shouldn't I do that with the entries as well? For me, it's easier to average up than it is to average down. So this is just in my experience. So we want to average up when it comes to selling. We don't want to average up when it comes to buying. So essentially, I try to buy my first position in a full position and sell my positions in halves or thirds, and it doesn't count towards PDT. So a lot of people give me that question, hey, is this gonna take away all my day trades? No, it's not gonna take away all your day trades. Now what you want to do in the end is combine all this with practice. Don't look to paper trade per se. Look to have a live account and use very, very minimal amounts. For example, let's say if you're just starting your account with $2,000, use only $100 per position. Yes, you're not going to be making any progress whenever you make a good, nice trade, and you're not going to be going backwards. But what it does is it still invokes that emotion there. The emotion may be very, very slight because you're still using real money, but it's not to the point where it kind of messes up your ability to make a good judgment on a trade. So essentially you're getting your feet wet, and as time goes on, as you plug in the numbers, for example, let's say you take 5 trades, you plug in all of the trade data, then you get to see, okay, I'm more accurate during this time. Hey, more accurate if I play this certain style. Hey, this is where I'm more profitable at. And then what you start to do is you start to add on more shares progressively. The biggest mistake people have is just throwing all their money into a single trade, having a bad outcome, and then that literally sets the tone for the rest of their trading experience. You have to progressively do this. So I hope this video helped. I know this may be a troubling time for a lot of people because the stock market and their 401ks aren't doing the best right now. A lot of people looking at other avenues. So I understand that. Hopefully this video is going to give you a nice little framework. And then any questions you ever have, you can always email me. You can always text me. Hit me up on the social medias. It's all going to be down below. I'm always happy to answer questions and get you guys into some green, get you guys some money. So let's do it.